It was another wild day on Wall Street with a little bit better outcome. There was a more than 500-point swing, and we closed up about 30 in the green. The index is still down more than 4% this month. Bob Pisani is down at the New York Stock Exchange. Bob, I was looking at the notes for what you were going to say at 2 o'clock, and I was saying, you know, we got to change what you're saying at 2. Things change for the better by the end of the session.
There almost is a complete one-year trend in the market that you can go through in a single day today. That's how crazy things are. So you're right. We saw a real nice bounce today because at the bottom, just around the European close, a large part of the market was seriously oversold. And not just oversold, a lot of it was already in bear market territory. It was just awful. You see the moves there on Brexit. You see the concerns there breaking through the October lows, and then the turnaround on the Apple talk in the middle of the day. The big problem right now are the banks. 23% off the 52-week highs. That's as a group. But the entire group's at new lows. Everything. Money center banks like JP Morgan and Citigroup, new lows. Regionals like KeyCorp, PNC. It doesn't matter. They're all at new lows. Energy down 20% right now, but deeper concerns look a little more deeper. Materials were down more than 20%. They bounced today. They're still down 19%. The industrials, communication services, technology, all down in the mid-teens. But because there's so many stocks in these groups, it doesn't really describe the extent of the damage very well. There's very deep bear markets that have developed in many subsectors, and not much of a bounce, frankly. Oil service stocks, Halliburton, Schlumberger, they're 40% off of their highs. Home building stocks and construction stocks are down a third off of their highs. The metals and mining are also down a third on global slowdown and tariff issues. And the same with the autos. The autos in the U.S. and Europe, it doesn't matter. And the dollar strength and slower global growth issues is also hurting emerging markets, particularly China, which is down 25% on the year. So where are we right now? The Russell 3000, which is just about the broadest index on the market, it's about 11% off its recent 52-week highs. That's, of course, market cap weighted. But the Russell 1000 equal weight index, this is the biggest 1,000 stocks, all equally rated, not market cap weighted, 12% off its high. So it doesn't really matter. That's a pretty good gauge of where we are. And Joe, I know you saw earlier, a median stock is 9% off. It doesn't matter at this point. You can slice it. Average stock, median stock, market cap weighted stock, it doesn't matter. Everything's down about 10 to 12%. And Joe, you want to see how clueless the market is. Apple turned around today on not a lot of talk in the middle of the day about technicals turning around, and we did this right on our air at 12 o'clock. I think that's a sign that the market really is looking for any kind of direction at this point and can be very easily moved. Back to you.
All right, Bob, thanks. One of Wall Street's biggest bulls says we could see a bottom as early as next week. Tony Dwyer of Canaccord Genuity joins us now. So, Tony, I was trying to figure out, was it 20? You were probably sitting on the Squawk Box set 20 years ago, weren't you?
It was
22 years ago?
probably 22 years ago.
22 years ago.
You said when I got on that's the last time I had hair, I think.
No, you got the same haircut. You haven't lost
Buddy,
any hair.
Bald is beautiful. Don't hate me because I'm beautiful.
No, I'm not. It's shiny, but used a lot of powder.
Not with the makeup.
Ran out of powder and makeup. No. Here's what I was thinking. So where do you think the Dow was then? Was it about 4,000 or 5,000, 6,000, something like that? My point. It doesn't matter. So we're at 25,000 now. So that we've been through a lot together in 22 years. The moral of the story is it's gone from 4,000 or 5,000 to 25,000. Now, where we are right now, this correction is gut-wrenching. Everybody's watching it. But if we know we're not going into the 70s, the 1970s, where 74, we ended up in that the most gut-wrenching thing anyone's ever seen. If that's not coming, if we're not falling off a cliff and we're now at 14 or 15 times earnings, do you get stocks more than 10 or 15% off their highs? Does it ever get better than that for people?
Joe, it could get a little bit worse, but as we saw today, it's impossible. Anybody that tells me that they can trade the daily movements here, or even weekly movements, is out of their mind. And you can see that because here's a great example. The tick index, which when you take advancing issues versus declining ticks on a given day, since the October lows, October 26th, October 29th, and last Thursday, you had plus 1,400 and then minus 1,400 on the same day. Basically, historic. You haven't had that for the prior 2 cycles ever. So you have seen historic volatility. That's a measurement in this cycle of when you're making what I call a shock drop, which we had in October. You had when the VIX rate of change, the 10-week rate of change, an intermediate term indicator, Joe, spikes to 80. In other words, over the last 10 weeks, the VIX is up 80%. then you go into this terrible bottoming process. I call it demoralizing. It's like the opposite of love isn't hate, it's apathy. It's when everybody's like, I don't care what Apple does, right? Because you're so out of it. That's when you're set up for a collapse in volatility. You notice how every retest down to 2,600 in the last month and a half? You haven't had the VIX really drop below 20. You haven't had that, okay, we're good to go. So for the viewers, I think what we try to do is educate as well as guide. What we look for, two things. You look for a reversal in the market that's big enough to drop that VIX 10-week rate of change down towards 0. We use 10 as our level. So it's still in the 60s. That's your indicator. That'll tell you that, okay, we've had a reversal that's good enough that the volatility guys are giving up on the higher vol, and you're good to go. And I'm sorry to go on a rant here, Joe, but when we started doing this in the early 1990s, we think this period's unique. I wrote it down because I want to make sure I get it right. Have we ever had a period where the president is under investigation by a prosecutor? You have Fed policy without rate rises, without inflation that narrows the yield curve to under 10 basis points, with trade sanctions on the second largest economy in the world. Well, that would be January 1994. Janet Reno appointed a special prosecutor to investigate Clinton on the Whitewater. You had a surprise rate hike and a 9% drop in February, a retest December 6th before the FOMC meeting on December 19th that flattened the yield curve to 7 basis points. And I haven't heard anybody that remembers this, because I didn't until I read it today, is that you had a trade sanction with Japan. Sorry.
No, it's okay.
But you had it was called Super 301. We had unfair trade policies with Japan, and Clinton put on trade sanctions with Japan.
So bottom line, Tony, is you think this is a world of issues in our face, and it's almost extreme. But why wouldn't that be a reason for more negativity ahead? I mean, everything you just said there doesn't seem ready to resolve itself.
It could be, Timmy, and that's why I'm saying you wait for those indicators, that reversal on the S&P 10-week rate of change from a -9, where it's at now, to a -5, and a 10-week rate of change on the VIX goes from up at 80, where it was in October, to 10. Those are your signs for the viewers that don't want to play with the day-to-day volatility, that, okay, over the last major corrections this cycle, it's been time to get back in.
And capitulation, I mean, you don't think we've had capitulation?
It sure, we've been doing this as technical guys for a while, Carter. It sure doesn't feel like it. I looked at earlier, somebody was covering the put call from Strategas. I thought that was pretty good. But, okay, we've all been doing this for a while. Has it ever paid to sell a down 10% tape when you're not in the purview of a recession-driven bear market?
And if it's not
a
secular bear, if it's a cyclical bear.
You know what's great,
One
Joe?
thing you failed to mention, and I couldn't help thinking, maybe there's collusion, Russian collusion, but if it's not, we're talking about another sex scandal with a campaign finance violation, which is what you were talking about, a sex scandal in '94. That's what that finally came down to, a blue dress, right?
Yeah.
I mean, it's bizarre how you just went through some of the similarities, but then we have 3 straight years of 35% gains back in the '90s.
And Tudor Jones covered it on CNBC today.
He said if it went down, you see that? He said if it went down 10%, he'd be buying, I guess, another 10 maybe.
Well, yeah, then you'd have capitulation.
I had a different take on that interview.
Yeah.
My take on that interview was he said that he thinks that this next rate hike is the last one.
That's what I was
That
gonna ask.
happened in
Right.
1995. You had a 34% gain. That happened in 2000. You had a 10% rally to retest the high. And that happened in 2006. You had another 20% to go before the recession. And again, remember, if we invert the yield curve tomorrow, I know people are so sick of me with this. If you invert the yield curve tomorrow, the 210 spread, your median gain is 21% over the course of the next 18 and a half months, with a recession not for 19 months. The only exception where it didn't work, and the market peaked first, was 1973, where you had an oil embargo and a spike in inflation that made the Fed go nuts.
So quick, I know you think then if the Fed, like Mr. Jones said today, if the Fed doesn't move in 19, that Fed put is in place, or the market view that as weakness in the general economy and sell the market? In
1995, you had 0.5% GDP growth in the first 2 quarters of the year. The Fed raised rates February 1st of 95. Tape was still up 7%. It's the perception of what the Fed's going to do where you recapture your multiple compression that we lost because of the tariff stuff and because of the Fed. So, again, you don't have to buy the next tick. You can wait for those 2 indicators. We're circling it. We're surrounding it. We've been
Most
talking
of the interview was about income inequality and the flaws in capitalism. Why do the billionaires always want to solve income inequality? Have you been able to figure that out?
It's amazing, and you don't want to be too skeptical and too dark about this, but it's amazing once you get there. you want to
don't
put
want
up
anyone else?
roadblocks
Yeah,
for others
other,
to get there,
it's
which is
weird.
totally ironic.
Anyway, thank you, TD.
Thank you.
Thank you.